Okay, so we were talking about free cash flow to total debt, and we can see that our current ratio, our quick ratio, our debt to equity. What about free cash flow to short-term debt? Um, this kind of chart, you got to kind of be careful about looking at this because when I look at the actual numbers in here, these are just ridiculous percentages. They've got 521.8% of free cash flow to short-term debt, 13,000%. I mean, essentially, short-term debt is nothing. So they have really no short-term debt. So these numbers are really irrelevant. Let's just call this the infinity for as much as that's worth. So they have really no short-term debt. So free cash flow is covering that. What about long-term debt? Again, if you look at this chart, it's ridiculous numbers, 4,150%, and then it really goes up. So seeing this spike here, it's really relevant. This might as well be infinity. They have really no long-term debt out there. The total debt number really comes from accounts payable and accrued liabilities. So their debt load is low, and as I've shown in my other videos, that's good for me. I like companies that have no long-term debt or very little debt out there. So this is from a chart perspective on how this looks, but we can see from these charts so far this is shaping up to be a pretty good company. So let's go through the statements real quick here and see what we've got going on. Again, we'll start with the balance sheet. Cash, there's nothing too fancy out here. Everything looks good. We talked about the current ratio already. You can look at their land and building. It's a very small part of their assets. Not a lot of fixtures in their business. Most of this is in stores, retail outlets. So there's not a lot of fixed assets out there, which is good. They're all about inventory and cash being their big asset bases. Which means it's good. It's going to turn into cash quickly. We don't have our capital tied up, which is why we see these extraordinary return on equity and return on invested capital, because we don't need to invest a lot of money. It's a lot of just spinning money in and out, buying inventory and churning it out of the stores as quickly as possible. So that's a nice thing to see. We have that flexibility in the business that we're not locked in. There is some goodwill in here that they bought some companies. Doesn't look like it's too bad. And I didn't see anything in there that was that crazy. I like to focus on liabilities, and if you've noticed in the videos, I do go to the liability section. How are they financing the company? Because I think this gives you an idea of how management is thinking about the company and how they're how they're generating the capital for the business. And it also gives you a level of risk in the business. Again, when you're doing a valuation, it's about how much is the company earning today, how risky is that cash flow, and how much is it going to grow. This section here, the balance sheet, gives you an idea of how risky it is. So it's one of the main components of doing a valuation. So if we look at their liabilities, they have grown over time, but where have they grown is the interesting thing to look at. They've got some other liabilities and some accrued liabilities out here. And when I took a look at these, what these really are commitments. The big chunk of them are commitments to the manufacturers that they have manufacture their handbags and manufacture their jewelry. It's a commitment. So it's not really a debt that they owe. It's saying, okay, sometime in the future we're gonna buy 100,000 handbags from you, or we're going to buy 20,000 watches from you, or we're going to buy 50,000 pairs of shoes from you in the next couple of years. So it's a liability because they have a commitment to it, but it's not really a debt, as in they owe it. They're going to get something in return for that. It's not like the cash is already in the door and they've got to pay this back. They're going to get that later, those assets. So these accrued and other liabilities are not really debt, so we can kind of take these out of the equation altogether because they're not something that we owe in the traditional sense. And if they're going to continue to grow, as we showed with the statement that they're growing free cash flow, they were going to do that anyway. So it's an obligation they have that they were going to do anyway. So I don't see this as debt. In fact, I think their debt load is a lot less than what these total liabilities represent, which makes them much, much safer than anything else. With similar debt loads, but it actually being long-term or short-term debt. And accounts payable looks rather small when you look at it compared to the total asset base. And when you look at long-term debt, it's nothing now. They don't owe anything now. They have no debt whatsoever, and that's been pretty consistent. They took out some debt in 2009, 10, and 11, which can make some sense, but they've promptly paid that back, so they don't really have any debt. So when we look at the income statement, again, what I look for is revenue growing every year, and yes, 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 yes. In fact, even through the down times, revenue has grown consistently. So they're constantly growing their revenue in this business. And as we showed in the charts before, gross margin very consistent. So as revenue is growing, gross income's growing right along with it, which is a very nice thing to see that they've maintained their brand as they've grown the business. SG&A has remained in line very consistently around the 40% range. It's a little bit high for me, but I'm okay with it because they have such a high gross profit margin. This SG&A is primarily made up of their sales staff at the stores, so I can make sense in that because they're trying to build an experience when you go in to shop there. So it's going to be a little bit more expensive for their sales force. Look at depreciation, very, very small. They have very little fixed assets. The depreciation is tiny again. And then operating income very, very high in the 30s, very, very consistently. So we're looking at a very stable company that's growing revenue consistently over time. Even in the dark 2008, 2009 days when everybody and their grandmother was scaling back, they actually grew their revenue and they maintained their margins during that time. So I'm very happy with seeing that. Interest expense next to nothing. I mean, very little interest expense, if any, over the course of the last 10 years. So they're shaping up to show us everything we've got, or everything we want in a business. Very low debt, consistent revenue growth, consistent margins. Free cash flow is consistently growing. We'll go down to the cash flow statement, look at operating cash flows, growing. CapEx, very, very little compared to their cash flow. And this is all growth CapEx. This isn't maintenance CapEx where they constantly have to be retooling machinery or anything. This is about growth. This money is spent on growing the business, not on maintaining the business, which is a big, big difference. Acquisitions, very little in the acquisitions world. This goes to that Oracle concept that we talked about, where acquisitions are important to growing the business. It doesn't appear to be that way in this business. Coach is Coach. They have a brand that they're managing. It's not like they have to go out and acquire different brands to grow, because they have their own brand identity that they're managing very well. Okay, so we go into financing activities again. This gives you an idea of how management is managing the capital structure. And here's something I always love: purchases of stock. They are buying back shares. That free cash flow is coming right back to us as shareholders every year. Net buying every single year. And they got really furious in 2011, 2010, when prices were a little bit lower. They went out and they were very aggressive in repurchasing stock. I like that. And they've been consistently buying back shares on a net basis. So it's not like they're buying and then reselling. They're actually keeping those shares in-house, which we like to see. Issuance of debt, nothing, negative. They didn't have any debt to begin with, but the stuff they had, they repaid. They had some debt in the early 2000s, mid 2000s, but they promptly paid all that back, and they're running a very lean and mean balance sheet out there. And then dividends paid. So we could see here recently that they've started to issue a dividend, which is a nice thing to see. Again, rewarding the shareholder. This seems to be a very shareholder-friendly company. They're buying back shares. They're keeping the balance sheet clean. They're issuing dividends. So it seems like everything is pointing in the right direction for this company. Everything out there seems right. So the question is, can we get in at a good price? What's a good price to buy Coach? because these companies, yeah, they may look great, but if everybody's already in, you don't want to overpay for it either. So let's clear this all out. We look at the growth rate here. Growth rate 15%, 15.6% whenever we look at this from a median average on how the spreadsheet calculates it normally. 15.6%. Does that make sense? Again, we saw revenues growing every year. We saw margins growing every year. So an interesting thing that I saw when I was doing my research was they're starting to focus into China and in the Asian markets. And again, everybody and their grandmother is saying, well, we're going into Asia and that's our growth opportunity. But I think Coach has a little different game. They are a brand that has status to it. They're a brand that people know, people like, and people respect, and people want. And it's a status symbol. As they move into these countries, they are going to become the status symbol of the rising upper middle class or even the middle class. As people generate more disposable income in these areas, Coach is the type of thing that they'll buy more and more. It'll be a status symbol for them. It'll be very important. And in those Asian cultures, status is a very important part of their culture. So a brand like Coach seems to be in this nice sweet spot with them. They're not exorbitantly expensive. They're not way out there in price and way overpriced, but they have a nice solid base. I asked my wife about this because I have absolutely no idea about fashion. I said, what do you think of Coach? And she said it's a good brand and people like it and people spend money on it and people really seem to gravitate towards it, but it's not ridiculously priced. It's not way overpriced. It's something I would like to go buy, and I would go shop for a Coach purse and not feel guilty about it later and not regret it when I get my credit card statement. So I think Coach is in that sweet spot where they're going to capitalize on the growing upper middle class in China and Korea and the rest of Asia and throughout the U.S. as well. They are still opening up stores here. As we showed in their 10K, they've only got 354 stores, which seems rather small when you compare it to Bed Bath & Beyond or Best Buy or Walmart, which have got stores on every corner. They actually have a pretty small base. And in fact, they're actually starting to go, they have some outlet stores out there. I know there's an outlet store near us too. So they're tapping into an additional market and a different price base out there as well for their products. So I'm big on this growth rate. I think 15.6 is good. I think it's not unreasonable to expect them to grow at that rate, if not faster. We're starting to see this market upturn a little bit, and as the market upturns, I think you'll see more and more people with more income. They're going to grow. They're going to grow their revenue base just upon people having more money to spend and wanting to buy. And again, with women buying purses, that's not something that's going to change, and that's something that's been going on for decades in the United States, and we don't see it abating anytime soon. So I don't see the market for their products decreasing at all in the near term, especially considering that their products are usually gifts. People usually go out and buy Coach products as gifts. So when you look at their sales trends, they've historically been spiking towards the fourth quarter of the year, obviously because it's Christmas time. People are buying the gifts, so they have that status symbol as a very nice gift as well, which helps the brand and reinforces my thesis that I think they have a strong market presence and a strong brand that's not going anywhere in the near future. So I can get behind this 15% growth because I think they have a long runway. They haven't saturated the market yet, and there are places they have not been yet that they could go to. I don't think they had anything in Europe yet, which seemed odd to me. I thought they would have something. For a company that's been around this long, you would think that they would have gone into the European market yet, but I didn't see too much on that. They're also growing their online presence, so people are shopping online for their products. So I could see 15% being pretty reasonable for them. They have the free cash flow to acquire other brands out there. They're big enough that if anything new and hot came on that fit with them, they could acquire it rather easily because they have the clean balance sheet where they could take on a debt load to purchase a company. and they have the cash flow to buy a company outright. So I could see that growth rate continuing